The Internal Revenue Service has quietly maintained a provision in the tax code that many retired homeowners have never discussed with their CPA, never reviewed with their financial advisor, and never considered as part of their retirement income strategy. Yet for some retirees, this provision has the potential to eliminate an entire year of federal income tax liability, while simultaneously reducing household expenses for decades. The surprising part is not that the provision exists. The surprising part is where it is found. Most Americans associate it with solar panels, renewable energy, and environmental policy. Few recognize it as a retirement tax planning tool. That misunderstanding may be costing retired homeowners thousands of dollars every year. Consider the case highlighted in our source material. A retired Arizona school principal, age 73, was facing a familiar reality shared by millions of Americans. Required minimum distributions from a traditional IRA had become unavoidable. Pension income continued to arrive. Social Security benefits remained taxable under federal rules. Together, those income sources created a recurring federal tax liability that had to be paid year after year. Like many retirees, he assumed those taxes were simply part of retirement. Then one conversation changed the equation. Not with a financial advisor, not with a retirement planner, not with a brokerage firm. A conversation with a neighbor introduced him to a section of the Internal Revenue Code that allowed him to apply a federal tax credit equal to 30% of the cost of a qualifying residential energy installation. The result was dramatic. His federal tax liability was reduced to zero. Unused credits carried forward into future tax years. His monthly electric costs dropped substantially, and according to the figures presented in the source material, the value of his home increased as well. This is not a discussion about speculation. It is not a discussion about stock market forecasts. It is not a discussion about hoping an investment appreciates someday in the future. It is a discussion about a federal tax credit established under existing law, expanded under the Inflation Reduction Act of 2022, and currently scheduled to remain at its full 30% level through December 31, 2032. Tonight we will examine exactly how this provision works, why so many retirees overlook it, and how a rule buried inside the tax code may be transforming a recurring tax expense into a productive household asset for thousands of American homeowners. Because for many retirees, the question is no longer whether taxes will be owed on retirement income. The question is whether those tax dollars must disappear permanently, or whether existing federal law allows them to be redirected toward an asset that continues producing value long after the tax year ends. To understand why this strategy can be so powerful for retirees, we need to move beyond the headlines and examine the actual regulatory framework. The foundation of this entire discussion is the Residential Clean Energy Credit, codified under Internal Revenue Code Section 25D. This credit was expanded through the Inflation Reduction Act of 2022 and currently provides a federal income tax credit equal to 30% of the cost of qualifying residential energy installations. According to current law, the full 30% credit remains available through December 31, 2032. The credit is then scheduled to decline to 26% in 2033 and 22% in 2034, before becoming subject to future congressional action. What makes this provision important is not merely the percentage, it is the type of tax benefit being provided. Many taxpayers confuse deductions and credits as though they accomplish the same thing. They do not. A deduction reduces taxable income. A credit reduces actual tax liability. That distinction matters enormously. Suppose a retiree receives pension income, Social Security benefits, dividend income, and a required minimum distribution from a traditional IRA. After all calculations are completed, the retiree owes $10,000 in federal income taxes. A deduction would merely reduce taxable income before the tax calculation is performed. A tax credit directly reduces the final tax liability itself, dollar for dollar. A $10,000 tax credit offsets $10,000 of federal tax liability. That is precisely why the Residential Clean Energy Credit attracts attention from tax professionals who specialize in long-term planning strategies. The credit applies to qualifying expenditures including residential solar panels, battery storage systems, solar water heaters, geothermal heat pumps, small wind energy systems, and certain fuel cell installations. The qualifying costs generally include labor, wiring, inverters, mounting hardware, and related installation expenses. Another important compliance rule concerns ownership. The taxpayer must own the system. This requirement eliminates one of the most common misconceptions. Many homeowners assume that solar leases and power purchase agreements qualify for the same federal credit. They do not. When a third-party financing company owns the equipment, the company, not the homeowner, receives the credit. The homeowner generally becomes eligible only when the system is owned directly, whether purchased with cash or financed through qualifying borrowing arrangements such as a home equity loan. The filing process itself is remarkably straightforward. The credit is claimed using IRS Form 5695 and then transferred to Schedule 3 of Form 1040. Documentation typically includes the installation invoice, completion records, and supporting paperwork provided by the installer. However, there is another compliance rule retirees must understand. The residential clean energy credit is non-refundable. That phrase carries significant implications. A non-refundable credit can reduce federal tax liability to zero. It cannot reduce liability below zero. In practical terms, if a retiree owes $8,000 in federal income taxes and qualifies for a $15,000 credit, the IRS does not send a $7,000 refund check for the difference. Instead, the remaining unused credit carries forward into future tax years, where it may continue offsetting tax liability. This carry-forward provision is particularly important for retirees because tax liabilities often remain relatively stable from year to year. Required minimum distributions create recurring taxable income. Pension payments create recurring taxable income. Dividend income often creates recurring taxable income. As a result, excess credits may continue producing value long after the installation year. The next regulatory layer involves state incentives. While federal law provides the foundation, many states offer additional programs that can further reduce costs. According to the source material, numerous states provide supplemental incentives ranging from modest credits to several $1,000s depending on location and program structure. Arizona, for example, offers a state credit equal to 25% of system cost up to a maximum benefit of $1,000. Utility companies represent another critical piece of the compliance framework. Many utility territories operate under net metering or similar compensation structures that allow homeowners to receive credits when excess electricity is returned to the grid. The specific rates, reimbursement formulas, and eligibility requirements vary significantly by state, utility company, and regulatory commission. That variation explains why production estimates, utility policies, and local regulations must be evaluated together before any financial decision is made. Perhaps most important for retirees is understanding how the credit interacts with required minimum distributions. The tax code does not distinguish between tax liability generated by wages, pension income, investment income, or RMDs when applying the residential clean energy credit. The source of the tax liability is largely irrelevant. The credit simply offsets federal tax liability once that liability exists. That means a retiree who cannot avoid an RMD may still have an opportunity to offset some or all of the resulting federal tax obligation through a qualifying credit. And that is the regulatory principle that transforms this conversation from an energy discussion into a retirement planning discussion. The tax code is not merely encouraging energy production, it is providing a mechanism through which certain retirees may convert unavoidable tax liability into a long-term productive household asset. Understanding that distinction is the key to understanding why this provision deserves far more attention than it currently receives. Understanding the regulations is important. Understanding the numbers is what changes behavior, because retirement planning ultimately comes down to arithmetic. Every dollar leaving a retiree's balance sheet must be examined carefully. Taxes matter, utility expenses matter, inflation matters, long-term cash flow matters. The reason this strategy attracts attention is that it potentially affects all four at the same time. Let us return to the retirement scenario presented in the source material. The homeowner was 73 years old. He maintained a traditional IRA valued at approximately $520,000. His required minimum distribution for the year was approximately $19,600. Combined with pension income, Social Security benefits, and dividend income, his total federal tax liability was approximately $9,800 for the year. At first glance, that tax bill may not appear extraordinary. But viewed over a decade, the picture changes dramatically. A recurring federal tax liability of $9,800 annually equals $98,000 over 10 years. Over 15 years, that becomes $147,000. And those figures assume no future increases in taxable distributions, pension adjustments, or tax law changes. Most retirees simply accept those payments as unavoidable. The homeowner in our example decided to examine whether the tax code offered another option. His solar and battery installation cost approximately $52,000. Under Internal Revenue Code Section 25D, he qualified for a federal tax credit equal to 30% of the project cost. That produced a federal credit of $15,600. Now watch the arithmetic carefully. Federal tax liability, approximately $9,800. Federal energy credit, $15,600. The first $9,800 eliminated the entire federal tax bill. The remaining $5,800 carried forward into a future tax year. In practical terms, an expense that would otherwise have been paid to the federal government remained available to offset future liabilities. But the financial impact did not stop there. The source material identifies an additional Arizona state credit of $1,000. A utility rebate of approximately $2,500 was also available at the time of installation. Let us total those benefits. Federal credit, $15,600. State credit, $1,000. Utility rebate, $2,500. Combined first-year benefit, $19,100. Subtract that amount from the original $52,000 installation cost. The effective net cost falls to approximately $32,900. Already, the economics look substantially different than the headline installation price. But there is another layer. Before installation, the homeowner's electric bill averaged approximately $210 per month. That equates to roughly $2,520 annually. After installation, the average monthly bill fell to approximately $11 during periods when consumption exceeded generation. Annual utility savings were estimated at approximately $2,188. Then came the net metering component. The system generated approximately 22,400 kilowatt-hours annually. The household consumed approximately 18,600 kilowatt-hours. That left roughly 3,800 kilowatt-hours exported back to the grid. According to the figures cited in the source material, those exports generated approximately $760 in utility credits during the first year. Now combine the annual operational benefits. Utility savings, approximately $2,188. Net metering credits, approximately $760. Total annual cash flow improvement, approximately $3,148. That number matters because recurring annual cash flow is often more important to retirees than paper gains. A retiree living on a fixed income does not merely need a higher net worth. The retiree needs lower monthly expenses. Every dollar no longer spent on utilities becomes available for healthcare costs, travel, emergency reserves, or simply preserving capital. Then we reach the final layer of the financial analysis: property value. The source material references research suggesting that residential solar installations increase home values by an average of approximately 4.1% nationally, with potentially higher premiums in strong solar markets. Using the example provided, a home valued at approximately $640,000 would experience an estimated value increase of roughly $26,240 under a 4.1% premium assumption. Now consider the sequence. Original installation cost, $52,000. Federal, state, and utility incentives, $19,100. Remaining effective cost, approximately $32,900. Estimated property value increase, approximately $26,240. Net economic exposure after accounting for both incentives and estimated value appreciation, approximately $6,160. Against that remaining exposure, the homeowner receives annual utility savings, annual net metering benefits, reduced tax liability, and an asset expected to operate for decades. Whether every homeowner achieves identical results is not the point. They will not. Utility rates differ. Solar production differs. State incentives differ. Property markets differ. But the broader lesson remains important. Many retirees spend enormous amounts of time searching for an extra 1% yield in a savings account, a certificate of deposit, or a bond portfolio. Far fewer examine opportunities to reduce recurring taxes and recurring household expenses simultaneously. And yet, from a retirement cash flow perspective, eliminating $1 of annual expense can be just as valuable as generating an additional $1 of investment income. That is the mathematical reality underlying this strategy. It is not merely about generating electricity. It is about converting recurring tax obligations and recurring utility costs into a long-term asset that may continue producing financial benefits for decades. At this point, the most important question is not whether the residential clean energy credit exists. The most important question is whether it applies to your specific situation. And fortunately, that answer can be determined through a relatively straightforward process. Before speaking with a contractor, before signing any agreement, and before making any financing decision, there are 3 questions every retired homeowner should answer. The first question is ownership. Do you own your home, and is your roof in reasonable condition? The credit applies to qualifying primary and secondary residences that are owned by the taxpayer. Renters generally do not qualify for the homeowner credit. Roof condition is equally important. If a roof is likely to require replacement within the next several years, that issue should typically be addressed before installation. Removing and reinstalling solar equipment during a future roof replacement can create additional expenses that significantly affect project economics. According to the source material, those costs can range from approximately $3,000 to $5,000. The second question is tax liability. Do you actually have federal income tax liability that the credit can offset? Remember, this is a non-refundable credit. A homeowner who owes federal taxes can use the credit to reduce that liability, potentially all the way to zero. A homeowner with little or no federal tax liability may still benefit through carry-forward provisions, but the timing of those benefits becomes different. For retirees receiving pension income, required minimum distributions, dividend income, or taxable Social Security benefits, annual federal tax liabilities of several $1,000s are not unusual. Understanding your specific liability is essential before evaluating the credit's true value. The third question is production. Can your property realistically generate enough electricity to support the financial case? Not every roof is equal. Solar output varies based on geographic location, roof orientation, shading, climate conditions, and utility rate structures. A strong solar location may produce substantially more electricity than a less favorable site using the exact same equipment. That is why estimates should never rely solely on marketing materials. Independent verification matters. Once those 3 questions have been answered, the next step is gathering information rather than making commitments. A disciplined homeowner should begin by obtaining an independent production estimate using the publicly available PVWatts calculator operated by the National Renewable Energy Laboratory. The source material specifically identifies this tool as a way to estimate expected annual energy production using location, system size, roof tilt, and orientation data. Next comes a conversation with a CPA or qualified tax preparer. The objective is simple: determine your most recent federal income tax liability and estimate how much of a potential energy credit could realistically be used based on your current retirement income profile. That conversation transforms speculation into mathematics. After that, obtain multiple quotes from licensed installers. The source material recommends comparing system size, total installed cost, battery storage capacity, estimated annual production, and documentation supporting credit eligibility. Multiple bids create a more accurate picture of local market pricing and help identify unrealistic projections. At the same time, homeowners should research available state incentives and contact their utility company regarding current net metering policies and rebate programs. These details can materially affect project economics, and because utility programs can change over time, direct verification is always preferable to relying solely on contractor estimates. Only after all of those pieces are assembled should the financial model be evaluated. Not the installation cost alone. Not the tax credit alone. The complete picture: federal incentives, state incentives, utility rebates, expected production, net metering rules, tax liability, financing costs, and projected long-term savings. That is the framework responsible retirees use when evaluating any major capital investment. The larger lesson extends beyond solar energy itself. The tax code contains numerous provisions that many retirees never fully explore because they are often categorized under labels that seem unrelated to retirement planning. Yet retirement planning is not simply about investment returns. It is about managing taxes, controlling expenses, protecting purchasing power, and preserving cash flow. Sometimes the most valuable financial opportunities are not found in a brokerage account. They are found in understanding how existing laws interact with the realities of retirement income. As always, this discussion is educational in nature and should not be interpreted as individualized tax, legal, or financial advice. Eligibility requirements, incentive programs, utility policies, and tax outcomes vary based on location, income, property characteristics, and future legislative changes. All decisions should be verified with qualified professionals familiar with your personal circumstances. For now, the key takeaway is straightforward. The 30% residential clean energy credit remains available under current law through 2032. Whether it is appropriate for your situation depends entirely on your numbers, your property, and your goals. But understanding the opportunity costs nothing. And for some retirees, that understanding may prove to be one of the most valuable financial conversations they have all year. Thank you for watching. Stay informed, stay diligent, and above all, stay committed to protecting the assets you spent a lifetime building.